following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
All right, and welcome to our Volatility Viewpoint segment. This is the portion of the show where Don and I usually bring on a guest, but we're lucky enough to have Bill on for the entire show this episode, so we can dive into a few more interesting topics here as well. And we can dive right into a kind of a continuation of some of the comments we were just discussing in the volatility review section, in that some of the inherent differences we're seeing these days between the implied and realized products. Now, first off, before we even dive into that, Bill, obviously the bulk of your efforts are on the implied side of the spectrum. Have you been watching any of these new realized vol products and some of the things that are coming out these days?
Yeah, I've looked at the realized products, and I think they're very interesting. But from a trading perspective, I tend to focus on the ETFs and the futures and the options related to the VIX and some of the VIX ETPs. So that's the realized portion is kind of a secondary, although I do find some very interesting market signals coming from that. So I use some realized volatility as to help call market direction changes and that sort of thing. So an interesting indicator, but I haven't ventured into the trading portion of that yet.
Bill, we seem to hear from a lot of people as we do our research and we try to gather intelligence that the supporting derivative products such as options and related ETFs could prove to be extremely beneficial for shoring up the volume going down the road, not just for the EuroFX vol contracts, but for the entire concept in general. I wonder if it would be your opinion as well, as we start to bring out other such realized volatility futures products, whether from a trader's point of view, you feel that the addition eventually of options and ETFs, such as was done with the VIX, would probably be a boon to volume.
I think it would be a huge boon to volume, just because there's kind of a network effect, if you will. You trade one part of the product suite, and it seems like all the other products in that suite or related products get affected. I also think that there's some very interesting pairs trading opportunities that I certainly am going to put a lot more research into. That I think, and I haven't studied those really on the FX platform, but I think as you expand the product line, that they'll be more attractive to me as an individual trader and probably institutions as well.
Sounds good. Thanks.
Now, Bill, when you look at realized vol products, is that just through your own calculations of historical/realized vol, or do you look at OTC vol trades as well, the variance in vol swaps, or what are you looking at?
Yeah, most of my stuff is in this fancy Excel spreadsheet, I must confess. No, so most of mine are internal calculations that I do based on, the major indices and that sort of thing. I do periodically look at some of the the CBO products and other third-party products, but I have a tendency to want to do whatever I can in-house, as long as it doesn't overwhelm my one-person research department.
So you're slinging a high-end Excel spreadsheet. Is that at least Excel 2010?
I've just upgraded, so now I can actually pretend that it's high tech.
Okay, so you're no longer in the dark ages of Microsoft Office 2000 or anything crazy like that.
No. Don't ask me what version of Word I use, because I'll get in trouble. But the farther back seems the one that's the most friendly to me.
Don, I think we know you're still using a Commodore 64 over there in your offices. Bill,
all right, You caught me again.
Now, Bill, obviously you do work a lot on the VIX end of the spectrum, and it's interesting to me to still see, even in this day and age, and even with the activity we saw over the past week being a good counterpoint to that, we're still seeing VIX being pushed and marketed and discussed in the broad media as a hedging tool and as a way to hedge your broad portfolio risk. Now, when people come to your VIX and More blog and ask you questions, I'm sure quite a few people do, I'm sure you get this question a lot, should I use VIX as a hedge? Is VIX a good hedge? What do you tell people? Did you recommend they go out there and pick up VIX calls to hedge their portfolio as opposed to S&P downside puts, or what are you telling people these days?
It's difficult because if you're new to the space of VIX products, then your ability to jump right into VIX options is close to nil. So there's generally a longer education process with the VIX products than there are with most other products. So you really need to learn the underlying futures, then you need to learn how the options work, and you need to be familiar with kind of some of the idiosyncrasies, everything from the different timing cycle, et cetera, before you can make an informed decision on how to use the product. And then they have the VIX doesn't move in a linear fashion. On some days it does have that convexity when the market really goes down hard, the VIX will spike up a lot. It kind of has an accelerated move. If the market goes up a lot, it'll have generally a more muted move. So it's a difficult product to trade. It's a difficult product to understand and get your arms around. That being said, if you have the background and knowledge or are willing to take the time and educate yourself, I think it has the potential to be, anyways, a relatively inexpensive hedge, as well as you kind of pointed to earlier, a sometimes inexact hedge when it doesn't necessarily track like it has been for the last month or so.
I have a question, and it's very possible that you've studied this on the blog. I tried diligently in the last few days to come up to speed, but you have such a wealth of material that despite my valiant efforts, I obviously couldn't read everything and get completely caught up. But pursuing this hedging concept a little bit further, we all know that in the equity space, we have this very strong negative correlation between volatility, whether it's implied or realized, and the actual price movement of the underlying, let's say an S&P 500 index. So we know that when the market goes down, VIX goes up, realized volatility tends to go up as well. And when the market goes up, usually in a more orderly fashion, both asset volatility and VIX tends to drop the vast majority of the time. I was wondering if you had done any studies, because I've tried to eyeball it day after day, watching days when the market drops rather sharply, looking at the corresponding VIX increase and taking the percentage movements of both to try to see a kind of a ratio, and then doing the same thing to the upside. And what I kind of eyeballed and found was that on days when there's upside movement, the VIX percentage move might be 4 to 5 times what the asset move is, but to the downside, on a very broad and generalized basis, it's almost twice as much, and you'll see VIX increase by 8 to 10% when the market makes a 1% move down, and by even more if you get a 2%. It's not linear, as you mentioned. I'm wondering if you've studied that or you've seen any studies relative to this, because you realize that the implication is for hedging, if somebody were going to use the futures, it'd be very difficult to be right in both directions as to the quantity, simply because the VIX doesn't move in the same magnitude given the exact same absolute value move when the underlying goes up or down.
No, that's a very good point. Yes, I have studied a great deal, have a lot of data on the subject, and I'm actually just finishing up an article for Expiring Monthly that'll go out in another week or so on this very same subject. So as a rule of thumb, if you consider that for every percentage move in the SPX, expect the VIX to go minus 4x. And that's a pretty good 4 to 4.2 is probably a good, but that just gets at kind of the median, and it's the values of the extremes that are most value to the hedgers. And it's always fun to do this on radio, is to draw this imaginary curve in your head, but the values start to accelerate and go up dramatically, steeper slope as you get to a sharper downward move in the SPX. And again, when you get to the bigger up move in the SPX, is a flattening out. So, and you that's just the VIX though, but the products are generally based on the futures, and then they have the futures that are pricing in some mean reversion, and so the futures don't really move like the VIX. So even understanding the VIX doesn't necessarily get you to where the futures are and where the options are going to be based on the futures. So that's part of the complexity that I was referring to earlier. But yes, if you can slay the VIX dragon, then you're halfway home, I think. And it does create a nice little kind of a C curve, if you will, with sharply up on the left side where that negative correlation is, and more flattening down on the right side. Again, great radio to draw these curves in the air.
Well, it's a very interesting phenomenon, and for our listeners, if this sounds a little confusing, I just kind of invite you, as you're watching your CNN or CNBC every day, where they disseminate the actual VIX, so the index, and then the market levels themselves. Just take a look when they show you the S&P. It's up or down by X% every day. And then take a look at the VIX movement and calculate that percentage change yourself, and you'll see just what Bill and I were alluding to, how when you have upside moves, you have maybe a little bit more percent or 4 times the movement, but as soon as you start going down, the same percentage downward movement accelerates, and you have larger. The complication comes, as Bill mentioned, that the futures simply aren't the same as the cash. So you can do all of that, and then when you've got the futures, you've got a real tiger by the tail, and it dances to a different metric.
It's interesting you brought up the futures, because we had Tom Sosnoff, the founder of Thinkorswim, on the show last week, and we got into a little bit of a discussion about VIX and VIX futures. And his comment was that for the vast majority of the retail audience, the VIX futures are essentially an irrelevant product. I found that to be interesting, and of course it dovetails in very well with what we see on Options Insider, and I'm sure you see on VIX and more as well. Is to this day, even without all the education that's been done on this product, still the number one question we receive on VIX options is, why don't they key off the cash? And I could make a living just answering that question if I could get paid every time and make a good living on a daily basis of the volume of times that question comes in. So do you agree with that comment that the VIX futures are essentially irrelevant for a large portion of the audience?
No, I actually disagree strongly. I think that many investors, retail investors in particular, think they're irrelevant, but then they go out and they buy VXX or they buy a VIX call, and they can't figure out why it's not moving the way they thought it was. And then there's a little educational process, hopefully, and then they realize, oh my goodness, I just thought I could kind of ignore these futures things. I thought I could kind of jump into the options or the ETPs because they were simpler. That's not the case. You have to, no matter what you trade in the VIX product universe, you have to understand the VIX futures.
So you think they come in with the futures being irrelevant, and then they get bit a few times, and then they are forced to learn about the futures and how they move the cash?
Mm-hmm. If you're a quarterback, I'm not going to worry about those blitzers. You get sacked a couple of times, and now suddenly you need to think about the blitz a little.
Well, it's pretty funny, Bill, and you couldn't be more right. I mean, people who are used to trading options, and I think that Tom was advocating, options are where the action is, need to understand that this is a rather strange creature. So they go in and they say, I want to trade volatility, and I'm an options trader. So, let me hit those options. They have to understand that options owe their existence to some underlying, but the underlying is not the cash, it's the futures, so that's what they're derived from. And if you're going to go in, you're going to claim that you're going to trade the options, and you don't understand what they're trading off of and what their value is based off of, you're going to be in a lot of trouble very quickly.
I couldn't agree more, and I can understand where Tom was coming from, but I see a lot of people getting blindsided by the VIX futures piece, and it's people, frankly, who have never had a futures account or are thinking kind of they can take a shortcut, if you will, and not having to bother to learn about the futures process because they don't have to learn about S&P futures to trade the spiders or something like that.
Right.
Would you say that's still the number one question that comes into VIX and more is why don't they key off the cash, the options?
Yeah, in one way or another, I think it has to do with that. Because since so many things get back to that, that becomes the root cause of a bunch of questions that land in my inbox.
That's interesting because that all stems from the way that this product was designed or redesigned back in 03, 04, as the SIBO sought to make into more of a tradable product and to mirror it off the way they designed the SPX in a lot of ways. And of course that made sense at the time because everyone and their mother thought VIX would be a purely institutional product. No one thought that retail would be diving into this, let alone in the droves and droves that we're seeing these days. And so now that we're coming up on 7+ years or so since the redesign, this product could be getting due for yet another redesign, perhaps to make it even more relevant to the way it's being used today. If they were to sit down and say, hey, we're going to redesign VIX again, what changes would you like to see made to the product going forward?
Oh my, I hate to say it, but I won't call it a flawed product, but a product with so many idiosyncrasies.
Go ahead. We call it a flawed product all the time.
Creates so many trading opportunities that I'd hate to see some of those trading opportunities disappear. On the one hand, I'm really not in the business of educating, but I've kind of ended up in that educational corner of educating a bunch of people about the product. If there was something to come out that was perfectly transparent and didn't have all these strange ETPs with contango and all these strange things going on, then I would make my trading life more complicated. But I'm not going to make a specific recommendation to how they might redo the product, although I can say that a realized volatility from a hedging perspective certainly has a great deal to recommend it, because you're more concerned with what's actually going to happen to your portfolio than what some sort of derived function about what might happen to your portfolio does. So I think it's an excellent complementary product, at the very least, when you look at alternatives to the VIX.
And Bill, it's really interesting that you say that about the trading opportunities, because we've been talking about this internally at the Volatility Exchange really for a couple of years now. And when we go out and we make presentations and people bring up VIX and we talk about our product, we continually don't want to be VIX bashers, because we understand very well that there are some very intelligent people making a living trading this product. And, who are we to tell them that we've built a better mousetrap and that we want to replace that product with ours? And it's really not what we want to do at all. We really do want to have this complementary relationship, if you will, Coke and Pepsi or whatever, and say that there's surely room for both, and that they will create hedging opportunities, spreading opportunities, intermarket type of trades. So this is what we're really hoping for, to really piggyback on the obvious success of VIX and tip our hats and say thanks very much for being there and blazing the way to get people talking about volatility every day. And now maybe you'll consider taking a look at this. It's an alternative product. It's got some interesting features, and then we can all live and play nicely together.
It makes a lot of sense. And when you think of that, presumably sometime in 2011, I hope we'll get RVX futures out based on the Russell 2000. And presumably a suite of products that grow up around that. And you've already got 16 VIX ETPs or volatility ETPs. They might not all specifically have VIX in them out there. There's a growing product universe, some of which are very actively traded, and some of which, as you point out, when you start combining pairs trades and have multiple legs or multiple products in your position portfolio, you can get some really interesting ways to play the market, play direction, play volatility, play no direction, play whatever. Really, no, all I can say is I certainly make a living trading just these products, even though I enjoy looking at the full spectrum of the options universe. The volatility product space is a big enough sandbox for a lot of people to play in.
Well, Bill, it's interesting. At the very least, I'd imagine you'd have to fall into the looking for a revamped settlement process, perhaps, for VIX. There is a chorus we're hearing these days, is that the settlement is just all over the board. It's a lot of times settling at prices we didn't see intraday. There's people who can go out there and attempt to game it by picking up these way out of the money SPX puts and try to game it that way. So I'd imagine you at least would be interested in seeing a revamped settlement.
Yeah, the settlement process is certainly not without its shortcomings. You can easily get around that by just not having any exposure on the settlement day, or make sure you have the weeklies or the next month or whatever in terms of your expiration. But yeah, it would be nice if there were days where the VIX settlement did not fall outside of the VIX trading range for that day, and there are some other ways to do
heresy,
that.
Sir. That's going to do it for our Volatility Viewpoint segment, and now we're going to roll into our Crystal Ball segment.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.